The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers from Akers Financial Group. I'm the president and founder. Here with me today is Nick Molite. He's a financial advisor at Akers Financial Group. Good morning, Nick.
Hey, good morning, Brian.
Nick Molite is a financial advisor at Akers. He's been in the industry for 16 plus years. Is the plus on there now?
There is a plus there now.
Absolutely. 16 plus years. So late teenage years in your financial services business.
Yeah, pretty much shot right out of the cannon into financial world.
Nice. All right. So today's show is an interesting show. So Nick has a background that we're going to explain as we talk through the show. We're also then that background makes him an expert in talking about this topic and makes him an expert. And you and him and I having a conversation about how Akers Financial handles the following, and that is investing cash. We're going to do a case study. We're going to have all kinds of talk about investing cash, the mindset behind cash, and mindset behind money in the bank, money that's not invested with risk, and what to do with that money.
Yeah, I'm really excited about this topic today, Brian. As you know, I started my career in banking.
Yep.
As a bank advisor,
just counting money in the vault, right?
Pretty much. Yeah.
That was a dream when I was about 12.
So, funny story,
Yeah.
the Brinks guys used to come by and bring the cash. And then, I'd occasionally help stack that vault.
Yeah.
This was prior to my license days. But we would, hold those big pallets of cash.
All right.
It's pretty fun.
That's cool. So Nick has a history and working with banks and being a financial advisor for banks. And so one of the things we're trying to do is just the idea that investing your cash, a lot of people have different mindsets when it comes to money. And one of the mindsets we want to talk about is people that love cash. They love cash. When I'm using the word cash, I'm counting about money in the bank, savings account, checking, things like that.
Mm-hmm. Things in the mattress.
Like, I'm not counting the mattress and the coffee can in the backyard, your wallet, all those things that I do have clients that have done all that.
Of course.
The shoebox and the gun safe, all those things. I'm not talking about that.
Coffee can.
We're talking about money that's liquid in the bank.
Of course.
And the thing is this. People say cash is king. What's your thought on that little saying, cash is king?
I think cash flow is king.
Oh yeah, I like cash flow is king.
Right. Cash or king is like you're in charge. You're the ruler. You have paramount power.
I use the word cash is king when a client comes in and says, "Hey Brian, we're going to move out of state to retire." My response is cash is king. It's going to cost you money. Both sides. You got to sell. You got to buy. You got to move. All cost you money. The more cash, the better. Yeah. And so the idea of cash is king is that means it becomes a number one priority in investing is to build enough cash to pay the bills.
Yeah, and also cash gives you options.
Yep.
Right. So when opportunity does present itself and you have adequate cash, right, you have options.
But there is such a thing as too much, and that's really what your case study is about, right?
Oh, yeah, absolutely.
Let's get right into that case study about cash, and tell me about your story. Did you make up names to protect the innocent?
No names necessary, right? So we'll keep it conceptual.
No Fred and Wilma, nothing like that?
We can call them Fred and Wilma.
All right, let's go Fred and Wilma.
Yeah, but let's just say, for example, Fred and Wilma are, getting to that retirement cornerstone, and they're thinking about retirement. They're getting close, and they sit down with a financial advisor and realize they never invested in the stock market.
Their whole career.
Now, they invested in retirement accounts, but as you know, Brian, you can keep cash or CDs in retirement accounts.
And that's what they had.
That's what they've always had.
All right, so they never took a risk with their money, the risk of losing.
Correct.
Ever. And so did they have enough to retire on?
Well, they do, but of course, it's not as clear of a picture as it would be if we had more of a more substantial base. If they would have been investing for the last 20, 30 years.
Yeah, so that's a very important topic, which we're going to cover later in the show. It's called the Rule of 72. When you make a decision on the risk level you take at 3%, it takes 24 years for your money to double. And that could be a lifetime for some people, 24 years of money sitting there.
Yeah, and 3%, that's
pretty good now.
It's not bad.
But
right?
I have people making zero in the cash, and we have a conversation like we're getting ready to have here.
Oh, yeah. In the banking world, 0.01 is a number that you see often.
Yeah. Oh, my. Okay. So the case study is all about this couple, Fred and Wilma, and they really never put it into the market their whole career. And so the conversation would be is they also did that with all the money outside of retirement, all their cash?
Yes.
I also assume they don't have any debt and they live very frugally. Is that all fair?
That is correct. And that's definitely helpful in this case.
That's the only way for that to work out, right?
Well, yeah. I mean, you look at the situation and you think, okay, well, we need to be more aggressive with our investments, or we need to save more aggressively, or we need to spend less, or perhaps a combination of all three.
And one of the things I like to say is in investing your money, there's two ways of doing it. If you want to make more money on your money, you got to take more risk, or you got to commit to more time where you lock money up.
Correct.
If we keep money all liquid and short-term and protected and no risk at all, you're going to earn the lowest rate. You're going to earn below a risk-free rate of return.
And it gives you this false sense of comfort, in my opinion, right? Your money's in the bank and, oh yeah, it's earning this great interest rate, but relative to the cost of goods and inflation, you have a great term, Brian, when it comes to, CDs.
Yeah.
Right.
Yeah. Well, CDs, I call it constantly depreciating because the concept of making money is you got to beat inflation after tax. And most CDs on the short term, like a 1 year, is priced to basically barely beat inflation and never beat it after tax.
Absolutely. And
your money doesn't make any money on your money.
So after tax means if you say get a 4% interest rate on your CD, but you're in a 24% tax bracket.
Yep.
What are you really getting at the end of the day?
3%.
Right.
That's it. If you live in Florida, because you don't pay state. Maryland, we get to pay state also on your CD.
Correct.
And so you end up having less than 3% effective yield on your CD, net real rate of return. And the idea is that really investing? And I usually would say it's not. It's parking your money.
Of course, yeah. It gives you that false sense of comfort.
All right, we've had a lot of conversations about your career and what happened and then why you're a financial planner now, an independent financial service advisor, able to do more things. Now, when you're part of banking, I know that there's tellers and then they refer people to financial advisors.
Correct.
And so there's what I want to do is just talk about an idea of some companies will basically design products to fill in the gap. So when someone comes in and says, if they say they have extra cash, and then they come meet the financial advisor, and that's when you start talking about investing in a non-FDIC, non-protected account, and that's when the advisors come in.
Yeah, non-traditional bank products, right? Yeah. So talking about things in the market, mutual funds, ETFs, insurance, annuities, things like.
Yeah, so one of the things you would teach the tellers to identify, there's three things you tell them about, and that would be the people who have money in the bank, they look at what are those three things? Yeah,
and the acronym I would use is TIM, T-I-M, right? Yep. Looking for our good friend Tim. And that's really how we can differentiate, who's a qualified person to talk about investing. Time, interest, and money.
All right, so time would be, they would know that the teller would know if the person has time to commit, that they don't need this money back, right?
Yeah, well, of course, you want to give your investment time to work for you.
Yep.
Right, and you don't need that immediate gratification, right? It's the concept of delayed gratification, allowing that money to work hard for you and giving it the time to do so. And then interest is not on the money, but interest in interest in possibly changing it all, right? Well, it's not your interest rate, right? It's you having interest in learning more about non-traditional bank products. And then the third thing is money. What do you mean by that? Money. You have to have that cash. Money. Or what do they say? They call it dry powder? Yeah, you have to have some dry powder to put to work, right? Yes, but above and beyond your emergency funds that hopefully you already have established. If not, we can help you to build that out. Yeah, so the bank path to investing would be make sure you have the time, make sure you have an interest in taking a little bit of risk, and have some money to actually do it. Correct. And then that leads to a product being sold that filled the need. I just want to say that, and not to say that that's wrong. I think it helps people to get them started and get them going. A financial advisory, financial planning is going to be different. And that we are trying to drive from the very beginning, what is the purpose of money? Trying to drive, do we have enough cash? What is your short-term goals? Know all the facts so that we can come to them and say, all right, because of everything's in place, you can do this. Oh, yeah, exactly. And, that's what I've noticed as I've progressed throughout my career. Yep. Kind of that organic transition from product to process.
Yep.
And that's what's most important. What's most important is the process.
That's why we got you here.
That's right.
Now, this process of planning is not easy. It's information. It takes multiple meetings. It's not a quick hello and sign here and you're done. It's a process. And you enjoying the process?
I love the process. And I look forward to the ongoing process as well, because you develop that relationship.
Yep.
And again, as you said, it's not one and done. You have to stay on top of it. Keep in communication, keep the relationship open. We need to make sure that the process is working. And if life changes, well, then we need to adjust the process as well.
What Nick's referencing there is that there are some cases where you might have someone that sold you something, and then that's it. There's no relationship long term. The difference in financial planning and financial services that come through independent financial advisors and financial planning is we want to be your advisor. We want to meet you this year, next year, every year, because your life's going to change. Things are going to be good years. There are going to be bad years. There's going to be years when you know things are going to start breaking, and you're going to need to build your emergency fund up. We're going to have to milk the cows, like I've talked about in many shows. Milk the cows, get the money in the money market to do. When we have too much money in cash as financial advisors, we say, we're fine, let's invest some of that. And then we help you invest it over time. This show is all about all of these things. Why do you have money in cash? How much do you have? Do you have enough? You might not have enough. So that might have to be your first priority in your financial life. Secondarily, what you might say is, I have more than enough. I don't know what the next step is. That's when financial planning and financial advice ties in. Yes. All of this works well together. We want people to win in their retirement years. By doing that, we want them to be very happy with everything that's going on in their retirement. Because we know the best part of retirement is getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com, scroll to the schedule meeting section, and let us know you'd like to schedule a free consultation with one of our team of advisors right there. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. What is your sleep factor? We'll explain this when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group, and we welcome you to our radio show podcast, Winning in Retirement. This is the second quarter. I'm here with Nick Molite. Nick Molite is a financial advisor for Akers Financial Group. He originally started his career in the banking industry and became a financial advisor there, and now he's more an independent advisor through Akers Financial now. And Nick is talking about our topic called investing cash, with all the goods, the bad, and anything else that we can talk about how you make decisions about your cash. Now, we're going to start the second quarter is this question: what is your sleep factor? Nick, what do you think about sleep factor?
Yeah, I thought about this. Brian, I have 3 kids. Yeah. My oldest is 13. Yeah. I haven't had a good sleep factor in about 13 years.
Yes. So sleep factor. So I have a client. Let's call him. I'm not even sure what name to call him. Let's call him Seymour. And so Seymour is a guy that has a certain thing about him where when I first met him, he did not want to invest any money until he felt comfortable. And then he goes, no, Brian, I want my comfortable to be my sleep factor so I can sleep at night. I need to be able to sleep at night. And Brian, I just need to sleep at night. Then after that, then I can invest money. And I said, well, what is your sleep factor? What's the number? And then I'll have to figure that out. The next meeting he tells me is $100,000 he needs to have in the bank for him to have a good night's sleep. I said, okay, well, let's work on that and build that first and make sure everything's all right. So we worked on that. We got there. I got to the sleep factor number, and I said, you ready to invest money? I'm not sure.
That's pillow money.
Well, there's the idea of, can I afford risk or not?
Yeah.
Sleep factor is really what I want people to think about is emergency fund. I'm okay because I have a support to back me up.
Yeah, if an emergency were to come up and you run to the bank and you can pull cash out very quickly and take care of that emergency, right? But what type of emergency would that be?
It's everything.
Right.
I mean, it's like the thing I tell people is, like when your car breaks down, it costs $1,000 now.
Yeah.
Tires, $1,000. It's like their number is $1,000.
Hot water heater?
That's $2,500.
That happened to me recently.
And then there's just everything breaks, costs money. And your insurance policy, you don't want low deductibles because you're not going to turn in small claims. You need high deductibles. And so high deductible, you need a cash to cover the deductible.
Of course.
And you don't want to just go in debt and use your credit cards. You don't want to just use your home equity loan. Some people say that, hey, I have a home equity loan for that. I don't have to worry about it. Well, the problem is that if we use debt for all the short-term problems, you become a debtor, not a saver. A saver is someone that's prepared for issues that are going to happen because they're going to happen. There's going to be a knock on the door. This year's been a big year of the technology industry getting knocks on their door saying, you got a month, you got 60 days, you need to find another job. Because we're cutting this out completely out of our company.
Well, that's what I was going to say. That's another big emergency. Short-term disability, or you get released from your job.
Right.
How are you going to cover your bills? Do you have 6 to 12 months?
Is that the number, 6 to 12 months? What do you think?
That's the number we like to use.
Yeah.
You make sure you have a year's worth of spending.
In retirement, I like it to be a year, absolutely. If someone has their job almost ready to go, I think 12 months. I think if you have a very secure job, maybe 3 months on the light end, but you need to have some other liquid money. 6 months is good. So 6 months of what?
6 months of spending.
All right. So what you spend?
Yeah.
Like you bring home, and what you spend is probably what you bring home.
Well, yeah, and it depends on how much you're saving. But what I ask my clients is, what does it cost on a monthly basis to be you?
Yep.
Right. Inclusive of your obligations, so your mortgage and your bills that you pay, but then also the other things that you do to enjoy your life.
Just quick advice I got to give people is don't leave it all in your checking account.
Right.
Because some people do that. And as a banker, isn't that high risk?
It's very high risk.
And what's the risk of?
Well, I just had this conversation the other day with the client. Right. If someone gets a hold of your debit account number or debit card number.
Absolutely.
Right.
They'll test it, right?
Oh, of course.
And then they'll go for the big number.
But if they clean out your checking account,
right,
it's very hard to get that money back. But have you ever had an instance, Brian, where somebody got a hold of your credit card information?
Absolutely.
And you got a call from the credit card company.
Yep. This doesn't look like you.
And they say, Brian Akers, did you charge $6,000 in Europe on train tickets?
Nope.
And how long does it take to have that process or that transaction canceled, and then you're not held liable for that cash or for that money?
It's amazingly quick if the internet's working.
If it's working, right? Exactly. But when you have substantial cash in your checking account.
My funniest story was taking my daughter to college. We stopped at 3 Walmarts in 2 different states on the way to college.
You got a phone call.
By the second one, they were denying my debit card at Walmart's, and so I had to switch to a credit card because I was just trying to buy the things as we wanted, loaded in the car, and kept going.
That's funny.
It was funny, but it was sad. I couldn't buy my Walmart stuff.
But you kind of have you feel good that they're looking out for you.
Yeah,
right.
It's a good feeling. It's not fun when you're trying to charge, you get declined.
Yeah.
But it is the right thing, especially when there's an oddity in your transaction. What happens though is some people they put all their emergency fund in checking. A simple thing is move it to savings. Put it into something a little different, so there is some in between the ability to pull all your money out of your account.
And you're not really earning any interest in your checking account. Either.
Right.
So you're not getting any bang for your buck in that regard. Absolutely.
So what we're going to talk about with emergency funds and having a good safety there, the strategy of investing that money is a very important thing we got to talk about. We got to talk about the emotions of security. Oh, it's in the bank. Now, the bank has FDIC. Now, explain FDIC to everybody if you can.
FDIC is where if the bank were to essentially fail, bank becomes insolvent, right? And you want to get your cash out. How do you get it? Who covers you, right? And it's the federal government.
The Federal Deposit Insurance Corporation, and there's limits, $250,000 per person that are on the account. Yeah, and there's ways you can structure that where you can increase the limits, but I explained to one couple recently. They had money about $500,000 in the money market. FDIC, and then it was in their trust, and I said you got 4 beneficiaries of the trust. The actual FDIC limit's $1.25 million for that bank, so that's not a bad thing.
It's not a bad thing, but the question is, do you really need that much cash? But I tell you, Brian, in banking as well, clients that would look for good rates, right? And they would spread, and they were looking for FDIC. Next thing you know, they have relationships with 7 to 10 different banks.
Yep.
Well, that can create a messy estate plan as well.
Absolutely.
Right?
Then you got to unravel it by taking I've had a client take his father to the bank to unravel them.
Sure. Because
that was his full-time retirement job, was going to visit everybody at the bank. He enjoyed it.
And if you don't know which banks they're invested in, you basically, I've told clients before, you have to wait for the mail to arrive.
All right. So we have FDIC through banks. If that's a federal deposit, it's the U.S. government supporting it, backed by what they charge the banks to be able to pay for it. FDIC has money, but a limited amount of money because it has had to pay claims over the last 15 years through different issues all around the country. The hard part is that is a protection backed by the government. So your banking, your CDs, the money market through a bank, you got to make sure it says FDIC.
Of course.
Money markets are not always FDIC.
Not always.
A money market through a brokerage account might not be, especially if it pays higher interest. So you do need to ask, is it FDIC? Is it not? Now, if the money's invested in treasury bills and government bonds, they're not an FDIC.
No.
They're backed by what?
Well, the full faith and credit of the U.S. government, right?
Which ends up being the same thing as the FDIC, right?
Yeah.
It's just a little longer process if there was some problem. So treasury bills, treasury bonds, those kind of investing, I-bonds through the Treasury Direct, things like that, have the backing of the government. So they are considered protected, guaranteed by the government, which is considered safe.
Yeah, it does give you a certain level of comfort knowing that your money is backed and protected.
And currently, CD rates about 1 year are a little higher than a 1 year Treasury. The 10-year Treasury gets a little bit higher, but these rates are constantly changing. As the Federal Reserve meet at different times, rates can go up, rates can go down. But the key thing here is when we have money to invest, if we're in CDs have, they get a 1099, an interest 1099, it's fully taxable. A Treasury, because it's federal government, the tax advantage is no tax in Maryland. So it's a little bit of tax advantage. So if Treasury and CD were the same rate, you give Treasury the advantage because you don't pay tax in Maryland.
Yeah, and that's great if you're a Maryland resident. However, if you're out of state, some states don't. You don't have to pay state income tax. So.
Absolutely. Now, the difference between banks and insurance companies do not have FDIC. They do not have government backing. They just have, on the fixed annuity side, fixed side with insurance companies, is the backing of the assets of that company, of the insurance company.
Yeah, I mean, you want to make sure you look at the rating of the company, and the rating is reflected upon their backing. How strong is their the general account.
Right. So when you talk about not talk about investing, but have emergency fund and money in there, what you got to do is really think about what to do with your money. Now, I think you have a farmer example of what to do with your money, don't you?
Yes, I do. When you have a lot of cash, it's like a blank canvas, right? What do I do, right?
Yeah,
and you
right.
can kind of caught like a deer in the headlights. But when you have too much cash, right? It takes me back to a term or a phrase that I heard early in my investing years. It's like a farmer with manure, right? And if that farmer allows that manure to accumulate and pile up over time, it starts to really stink.
That's true.
Right?
Very true.
Yeah. But if that farmer then takes that manure and spreads it out, and spreads it around, what happens?
It's really stinky that day. He spreads it out.
It is stinky that day too. But then things start to grow.
Oh, okay.
Right?
All right. So the key thing here is
spread it out.
If you spread things out, they'll start to grow. And that's the difference in having your piles all in one pile that stink.
And then you can harvest.
Oh my!
There's probably farmers out there rolling their eyes right now.
Yeah, they're like they butchered that example.
Yeah,
but it's okay. I have been with my cousin on a farm in the manure pile before in a tractor.
I'm sure
it is stinky.
Right?
Very true.
Well, now you're going to start thinking about this conversation next time you're out there.
Absolutely. All right, Akers Financial Group. We are diversified in many different ways, and diversified in our conversation. We've been talking about investing cash. We think that's incredible that you invest your cash for the long term. You invest your cash with purpose. Now, at Akers Financial Group, we're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville, Forest Hill, all around the Mid-Atlantic region, clients all around the country, and even a few around the world. It's so easy to begin winning in retirement. So just give us a call and schedule your meeting with one of our team of advisors. Call 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to akersfinancialgroup.com or call 833-946-7384 to start planning for your retirement now. Are you working for your money, or is your money working for you? We will talk about this when we return with more of Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed. Welcome back to Winning in Retirement. This is Brian Akers. Here with me today is Nick Molite. We're doing a show called Investing Cash. We've done a case study. We've had our talk about the investments people could do. We had your talk about manure stinking, but if you spread it out, it causes things to grow. So we've learned a lot so far in our show. Here in the second half, we're going to try to apply this to many different ways for our clients, for people that are listening, and the clients that we currently have that we already do all this for. So at Akers Financial Group, we are financial advisors. We're independent financial advisors to where broker-dealer, Arcadios Capital, and Arcadios Wealth is our investment advisor representatives through there. As we talk today, understand that there is the idea of investing, and we're going to differentiate the word investing and parking, leaving your money in the bank. So we're going to begin the conversation by my comment. Are you working for your money, or is your money working for you? So you mentioned early on the amazing rate of 0.01.
Yes.
And then when will that double in people's lives? Never.
No. And how will it be able to double your money?
Yeah.
Oh gosh.
Never.
A couple thousand years maybe.
Yeah. So the idea is, if your money is in an account making 0.01, 0.04, or anything like that, it's never going to double. It's never going to work for you. It's just going to be a parking place.
Of course.
And so the idea of money working for you is where this money, you basically give it a job. And that job is, hey, you go get your 4% or 3.5% interest, whatever, and next year you'll be worth 3.5% more, and that's okay for liquid money, that purpose.
Yeah, well, I mean, there's value in that, right? And that's what you need to see. And just going back real quick with that interest rate, I think listeners out there today need to know, do they all know what their interest rate is on their savings account?
Yeah.
Are they getting 0.01? Are they maybe getting 2, 3? Right?
Yeah, absolutely. I'm totally off script, but there's these lawsuits out there for stockbrokers and things like that because of something called a sweep account. It's in a brokerage account. It's a money market that pays lower interest, but the brokerage firm makes the float, the money above it. And then what has to happen in brokerage accounts is you have to trade to a different money market out of the sweep account to make more interest for your clients. And it's a hard job to keep that up.
Yeah.
But there's been this fundamental thing of people making a lot of money off of float. We're not going to try to have a show about that, but you need to know where your money's invested, even Absolutely. Your cash.
Yes.
That cash needs to be working for you.
It does. And as you said, a parking spot, right? Mm-hmm. So that brings up a term, why are we investing in a short-term solution when we have a long-term problem, right?
That's pretty deep there, Nick.
Or a long-term need.
I like the long-term problem.
Right?
But it's a problem when we say, hey, to do the job, I'm going to put my money at 0.01 interest, and then I'm going to be able to retire.
It's not working very hard for you then.
And then the math goes like this. So we need $2 million. You need to save all $2 million because that money is going to do nothing for you.
Exactly.
If we start younger in life and we use the concepts of how your money can earn money, and we talk about doubling, if you go from savings account to CD, all of a sudden from never doubling, it doubles in about 24 years. Mm-hmm. So the younger you are, you might get one double, 1.5 double. So your $1 might become $2 to $3 during a lifetime if you leave it in a CD. But it's not going to be money that does multiplication like the stock market. Absolutely. What kind of doubling does the stock market do, Nick?
Well, that all depends. If we're looking at individual stocks, right, with high risk, if a stock can double, right, the likelihood there it could be rather quickly. But you could also lose your money very quickly as well.
So the rule of 72, what does that do for us?
Oh, well, the rule of 72. So the way that I explain it to my clients is they say, all right, Nick, how long will it take me to double my money? And I say, well, that depends on your rate of return, right? So if you are, say, getting a 7.2% rate of return, right? You take 72 divided by 7.2, that gives you 10 years. So at 10 years at an average rate of 7.2%, you'll double your money.
So if you're 30 and you have $1, it'll be $2 by 40, $4 by 50, it'll be $8 by 60.
And you get a cup of coffee when you're 60 years old.
Maybe. But you might want to put zeros behind the one. But the idea is 7.2 actually gets that money getting somewhere, and the money does work for you rather than you working for the money. You need that money to work for you. But
now that 7.2%, you can't get that in a fixed account.
In a risk-free rate world, we're at a 10-year rate, we're at 4.2. In the short term, we're at 3.5 maybe on the guarantees. Beyond that, everything that pays more than that has risk to it. Risk, when we talk about risk, is risk of losing your original principal, risk of losing your money.
And when you avoid risk, you avoid the other R word, which is reward.
Absolutely, because there's this concept. I went to Virginia Tech. You knew that, Nick, right? At Virginia Tech, finance major, let's say a long, long time ago.
Okay.
That's the best way to put it.
Sounds good.
80s was probably when I went, maybe. But at Virginia Tech as a finance major, we learned the concept of real rate of return. Real rate of return is we got to beat inflation and we got to pay our taxes. That's all the time. Because you got to keep up with just what your bills are.
Cost of goods.
If your money does not beat inflation, then you're not keeping up with the original money. You're losing the power of your money.
Losing slowly. And that's kind of,
it's like a frog in a warm water.
Yeah, right? Or it's ninja-like. You don't see it happening.
Yeah.
Right?
But it's gone at some point in time. Usually 12 years out, all of a sudden you're retirement, 12 years out, and you're wondering, hey, I can't pay all my bills. I need more money on my portfolio. And then we're like, hey, we're going to use more than we're producing because we didn't take any risk. And this is all it can do for you.
Yeah. I mean, we do the same thing with our projections for our clients' spending needs, right? I'm going to increase your spending need by 3% every year.
Right. I used for a 40-year average inflation rate of 3.72. And I use that number to project to the future. That means around almost 4%. That means your cost of living doubles every 16 years. Will your money keep up with that?
Yeah.
My argument over time is that if you are sitting in cash, it's parked. It's not invested. It's not money you're going to live off of. A lot of times I totally exclude that in retirement planning because we're going to always need cash. We don't count that for living off of it.
That's right. I mean, we've done it in our seminars when we've shown the illustration that a cost of a house has increased by 10 times in the past 50 years.
The thing I tell people is like, my parents bought a house in 1969, and they bought a minivan for double the price of that house.
Right.
And it's like, what's going to happen nowadays?
Yeah, but that didn't happen all at once. It happened slowly over time.
Yeah, 50 years, but 50 years is a career and a good long retirement.
Yeah.
Your money it's got to keep up with you. It's got to keep up with the cost of living, cost of expenses. It's gotten very expensive the last decade. Inflation hits us, gas prices, all kinds of things costing more money.
Yeah, the grocery store used to be an enjoyable experience. Slightly therapeutic, at least for me.
All right. So we have clients, they have money in cash, and we get through the emergency fund, we get through short-term things they need, and we get to a point where they understand they need to take some risk to have a real rate of return, and then they want to start investing, and we're going to start investing. If they've been all cash their whole life, I think they ought to be very cautiously investing into the market, don't go all in at once.
Absolutely. You ease into it.
And so we use dollar cost averaging as a process of getting people into the market over a year, 18 months. And that's where you put money in a little bit every month, every quarter, and buy the volatility of the market, because we don't know if the market's going straight up from here, sideways, down. We just want to buy over time because we don't want you to put your money in and all of a sudden you see a 14% normal market correction and you're panicking, you get right back out because that was your first toe in the water.
Yeah, and we've seen a lot of volatility in the market, recently. So of course,
every couple of months it's different.
Yeah, and I think the concept of dollar cost averaging, number one, some clients don't even realize they're already doing it.
Where are they doing it?
In their retirement accounts at work, in their 401ks.
Because they're buying every paycheck. In previous shows, what I've said is that that's a great thing to have dollar cost averaging and buy the market with those contributions, because you want to buy that volatility. You almost want it down when you're buying.
Yeah, it's a sale day.
Actually, I do want it down.
Of course.
Buy.
Yeah, we on payday, if the market's down, we're getting in at a discount.
Yeah.
And then the other concept of that is, you can't try to really time the market, right? And the cliche term is time in the market.
Absolutely.
Not timing the market.
Yeah.
So that slow and steady wins the race, dollar cost averaging over time, compounding interest, all of that. That's the delayed gratification, right? It's not going to give you that immediate satisfaction, but you're doing the right process.
But everybody wants to get rich quick, and they all have the newest, hottest idea, and they got a new way of doing it to day trade to make a lot of money. Now, some people found ways to make money like that.
Yeah.
That's not the average person. That's a rare person who that's their business. That's what they do. They're trading certain indicators, and they're making it work that way. Yeah. We have portfolio managers that do the work for us like that, but we're also not supporting market timing, day trading in the way we invest. We want to be long-term investors over time.
Oh, yeah, of course. And then you're also taking high risk in that regard. And
because in the day type trading, you're actually trying to make a good buy decision, a good sell decision.
Yeah.
And you could mess them both up, and before you know it, you're upside down.
Correct. I call it double Dutch. You got to, you're waiting to jump in, and then you don't know when to jump out, and you don't want to mess up, and you have to continually
That's
be
the jump roping game, right?
That's right.
Yeah. Not. I don't do that anymore.
No.
All right. So what we've been talking about here is this. Are you working for your money, or is your money working for you? Now, the money working for you, we want to recommend that you build a more diversified portfolio. You spread it out. That causes things to grow over time, and that'll help you beat inflation after tax. That's the idea of real rate of return. That's how we try to take these ideas, these concepts, building your permissions, building your security, and then we start taking risk with money that you can take risk with. That's how we do it.
That's a great line. Money that you can take risk with.
We do this all the time with our clients. We do this for a living. So you don't have to figure all this out because we help you. We love doing it, right, Nick?
That's right. Love being able to help people.
Planning for us is something that is first in our mind, because once we do planning and understanding what's going on in your life, we can then knock down the exact answers, the exact recommendations, what to do, because it'll be taken care of. It'll be planned for, and that helps take care of whatever goes on in your life. We plan for this. We're going to be okay. Perhaps you've been sold something, regardless of whether you needed it or not. Not at Akers Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on your unique fingerprint that determines where your money goes. It's not about us, it's about you. So go ahead and give us a call at 833-WIN-RETIRE and schedule a free in-person meeting with one of our team of advisors. That's 833-WIN-RETIRE. 833-946-7384, or visit our website at akersfinancialgroup.com. What is your purpose for your money? We'll explain this in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to the fourth quarter of Winning in Retirement. I'm Brian Akers, Certified Financial Planner Practitioner from Akers Financial Group. Here with me today is Nick Molite, Financial Advisor from Akers Financial Group. Ready to go fourth quarter, Nick?
It's fourth quarter. Hands up.
Fourth quarters are incredible, especially massive comebacks. I love them. I think it's wonderful in any sport just to watch the fourth quarter. Now, what we're doing today is you're watching the fourth quarter. But if you missed it, you missed the first three quarters, go to our website at akersfinancialgroup.com. That's AKERS financialgroup.com, and go to the radio podcast tab, and you can follow our shows that we've done throughout the past. Many, hundreds of topics there. Listen in, and you'll be able to understand our mindset, and then give us a call. All right, today we've been talking about investing cash and the concepts of investing cash, and then how to actually do it. How do we do it at Akers Financial Group? It all ties into our topic of the fourth quarter, and that is this. Do you have a purpose for your money? All right, Nick, so when you're meeting with clients, do you ever start with this, or how do you bring in this in a first meeting about purpose for your money? What's your way of doing that?
I think the best way to ask is, what's your goal for this money? Do you have a specific goal for this money?
Yeah.
And that opens up the conversation, right? If you don't have a goal, well, then we need to talk more about the big picture plan.
Right.
But you kind of use that bucket strategy, right? I have this money put aside for this purpose. I used to see it in banking with Christmas club accounts.
Yeah.
Right. You'd see that, and clients would have money that they were saving.
Explain Christmas Club to me.
Right. I don't know that they even still do those anymore.
Some of them do,
but it's a separate savings account where you just kind of squirrel away money to spend at Christmas time.
Do you make interest on those?
You would, a little bit.
So it's like a little separate saving, and you put so much in at the beginning of the year, or do you put so much a paycheck? How does that work?
Everybody does it differently, but I think the concept is to compartmentalize that money. Take it out of your day-to-day checking, your normal savings, right? Because that money is specific to a certain goal for Christmas spending.
I have clients that allocate among 20 different accounts because they budget everything, almost like an envelope system. People used to cash their paychecks out and put in envelopes for their budget.
Right.
And now they do it digitally with accounts. Some just do it on spreadsheets. There's all kinds of ways to manage their money.
Yeah.
But purpose, in that case, is managing the day-to-day, so their head's down. What we wanted people to do is look up. What's your purpose next year? Purpose of this money down the road? Are you truly providing for your future self by putting some money out there?
Yeah, and I think goals are super important everywhere in life, especially when it comes to investing. But you need to segment short-term goals, mid-term goals, and long-term goals.
What's midterm? How many years?
Oh gosh, I mean, I usually use midterm as anything before retirement.
Before retirement, okay, so not like 2 years or 3.
I mean, yeah, that somewhat fits in.
So when does long-term kick in?
So I would say retirement accounts, IRAs, Roth IRAs, 401k, 403b, things like that. I mean, if you have a 15-year plan, but more often than not, that's going to kind of fall in line with your retirement.
Yeah, so on personal money, like if you have money in a regular checking bank account and we go long-term, I'm probably going to use long-term as a 5 years, and that money is not needed for 5 years. And so as we build a ladder is where you might invest for 1, 3, 5 years and build money out and try to get money able to accumulate over time. Yeah. Now, on the fixed side, we talked a little bit about insurance being guaranteed by insurance companies. We never did talk about something called a fixed annuity, like a MYGA, multi-year guarantee. Can you explain what that is?
Yeah, so multi-year guarantee annuity. What does that mean, right? That means that the insurance company guarantees a certain rate of return for multiple years, as described on the contract. So much like a CD operates, a 1-year CD, 2-year CD pays a certain rate. Same thing with the insurance company. Now, little nuance difference there with the insurance company are obviously the backing and then the way that you're actually taxed on that money as well.
Yes, I like these for people over 59 and a half so that we don't have to worry about penalties. So like if you do a 5-year, a multi-year guaranteed annuity, and if you're under 59 and a half and you want that money, you got to pay tax on the interest and a penalty of 10%. So you got to be careful with those. But what happens when you think about money in the bank and you look at CD rates and then you look at 5-year fixed annuity rates, they're actually better than the CD rates.
They are.
But that's because you're going longer and you're adding a little risk, and that's no longer FDIC. It's insurance guarantees.
That's right. It takes me back to my banking days when we would talk about interest. Right? And what type of interest does the client want? Right? And the client says, I'm trying to get the best rate for my money. Or are you trying to get the best taxable rate? Are you trying to get the best tax deferred rate?
Yeah.
Are you trying to get the best tax free rate?
Right. And that would dictate what you actually how you invest your money.
That helps us navigate to the next set of questions.
And those set of questions involving with all the pure planning can lead ultimately to implementing lots of different types of vehicles or tools or products that are out there. Being independent financial advisors, what's great is the tool belt's full of options, full of ideas that we can bring to the right purpose of the money.
Yeah, and that's the thing, though. We can't make a good recommendation. And it gets to the point where you're looking at a large CD or a large savings account. You say, I really can't give you a good recommendation until I know what the big picture, the big financial picture looks like.
I've been so big on this whole tax efficiency thing. Tax efficiency is, are you being efficient with your money? Now, if you're in CDs, what happens is all of it's taxable at the full ordinary income bracket. It might even trigger other things like IRMA for Medicare being charged more. If you use treasury bills, you save some Maryland tax. If you actually invest some of it more tax efficiently and don't pay tax to the long-term future, that's a great way. Capital gains, dividends are all at lower rates than ordinary, than CD rates. Understanding tax law is extremely important with liquid money, non-retirement money.
Absolutely. And especially understanding your own taxable situation as well.
That's all that matters, right?
Right, yeah.
I don't care about yours.
No.
I do personally care, but not really. But so the idea is this. When we're talking about investing and having purpose, one reason with personal money, you need to be tax efficient. That's one. The other one is if you want income, well, what kind of income do you want? Do you want it guaranteed for life? Or do you want it to come off a portfolio mix where portfolio changes and your income could change down the road?
Predictable income, right?
Sustainable, predictable, reliable,
right?
But money you can't outlive are all parts of building a great future.
Sustainable, predictable, reliable.
Yeah, I like that combo.
That. That's great.
Now, beating inflation. What do you think of that?
It's a tough job these days.
Yeah.
Right?
It can be when it's like a few years ago, it's probably 8-9% 1 year.
Yeah. Well, that's the thing, right? We can get a little short-sighted with inflation. Right now, yes, inflation's high, but there were times when it's low. But over time,
and inflation is one of the reasons we need to have money in stocks in retirement years. If we're going to retire, and we're going to retire at 15, 20, 25, 30 years, and money needs to double to keep up, I think it's very important to beat inflation by having some money at risk. The fundamentals of retirement, a lot of people will have Social Security income. I don't believe Social Security is going to give us many raises over the years. There's a possibility in 2032, 2034, they could reduce the payout. And so what are you going to do if they reduce? So you're going to have other money that has grown to help support you at that time. These are purposes and reasons to invest.
Absolutely.
And so what happens with a portfolio design is by taking your income flow, projecting that out, looking at where shortfalls may be. This might occur when one spouse dies. It might occur when something ends. It might occur when you retire. There's these moments of life when, hey, I need more money.
Yeah. And you talk about efficiency, right? And when we're looking at portfolios, we want to look for those, especially if it's a new client or new prospect, the inefficiencies in the portfolio, right?
Absolute inefficiency. And what do you mean by that?
Well, if something's not working hard enough for you, or if you are over concentrated in one area, or you have no income producing investments.
Oh yeah, they need money.
Yeah,
but nothing's producing income.
Yeah, maybe they need income, but they're all growth.
Yeah,
right.
They take too much risk.
Too much risk. Of course.
We have had clients with no risk at all. We've had clients where when the market lost in 2009, they haven't gotten back in. And so getting them back in is hard, but you got to slowly build the balance. But it all comes down when you know your purpose for the money, you can know the risk, and then you got to get into the idea of how does someone take on a risk who's never been used to that?
Absolutely.
And then do you need to risk your money? And I think it's very important to understand if you need to risk it.
Well, and the financial plan really allows us to identify how much risk they should take. Yeah. Right? So if you're well-funded, and you really don't need to take on a whole lot of risk, then that's great. We need to make secure the income, right? And then try to get at least outpacing inflation over time, right? But
and I would say that's not your normal American. Normal American has been spending a lot of money. They live within their means. But if they're spending a lot of money, a lot of credit card debt, they better have their retirement money in stock market, because they got to keep up with themselves.
Of course.
Because their need number is going to be huge.
Yeah, and you just kind of said something very important, which is that credit card debt, high interest credit card debt. I've seen so many clients that carry debt on credit cards with a high interest rate.
Money's in the bank.
17%, right?
Money in the bank earning zero.
But that comfort money, earning maybe 3%, right? But you're losing and you don't realize it.
Yeah, that's one of the fundamental things in the first year is trying to get everything balanced out, know everything is going on, get it cleaned up. Yeah. Because retirement to us is all about cash flow. It's about money coming in, money going out. Your money needs to work as hard as you do. When you want to stop working, that money better be working.
That's right.
And so the idea today was investing cash. We did a little case study about someone who really had cash everywhere, 401ks, all kinds of things. Know how your 401k is invested. I think it's very important that you know the investments. Financial advisors, we can go over them and help you select.
Yeah, right bucket, wrong strategy, right?
So say that slowly.
Right bucket, right? So they have retirement accounts.
Retirement bucket.
Wrong strategy.
Wrong strategy and how they invest,
Yeah,
right?
correct.
So right bucket, wrong strategy is just one of the many reasons to see a financial advisor at Akers Financial Group and to be able to begin a process of where you are now. Where you are now, we call that your unique financial fingerprint. That's you. It could be someone who's saved extremely well and what to do next. It could be someone who wants to begin saving, wants to start growing. You might be changing jobs. All kinds of reasons to begin starting. All right, Nick, I appreciate the good show. Thank you very much, man.
Oh, it's great to be here. Thanks, Brian.
I like the long-term experience, and I appreciate the show, even though you did bring a newer joke up early on. So,
I hope some people liked it.
Someone did, at least one. All right, so today we did cover investing cash. We do look forward to meeting with you. We want you to win in your retirement by taking this opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting right there. That's akersfinancialgroup.com, or you can call us at 833-WINRETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to our website, akersfinancialgroup.com, or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.